What is going on? We are at another Tuesday home finance hack. So we've made it, and this episode, rather, we're going to be talking about some things. Obviously, that are going to save you some money when it comes to your down payment, when it comes to your closing costs, when it comes to you purchasing a home in general. But particularly, we're going to be discussing what loan program should you be going with. You have a few different options out there. Most people just default to an FHA loan. And so I'm going to talk about some of the benefits of an FHA loan, but I'm also going to talk about some situations in which you don't want to go for an FHA loan and you might actually want to go for a conventional loan or a VA or a USDA loan. So let's jump on into it. FHA is the most common loan for first-time home buyers. That's where most people default to. FHA has the lowest requirements when it comes to getting approved for a home loan. They have a lower credit score requirement. You can get into an FHA loan with as little as a 3.5% down payment and a 580 credit score. So as long as your credit score is 580 and above, you can get in there with an FHA loan. FHA also has the most lenient requirements with your debt to income ratio. They allow for higher debt to income ratios than what you will find with a conventional loan as well. So FHA tends to be that default. And there are a lot of pluses with that. Obviously, easier qualifications. FHA has some competitive interest rate pricing. So that's another plus to help you qualify for a home, but also to help keep that mortgage payment a little bit lower than where you might be experiencing it in some other loan programs. But some of the drawbacks of an FHA loan are, one, you have mortgage insurance. Mortgage insurance is on every FHA loan, regardless of how much you put down. So typically, a lot of people think, oh, if I put 20% down on a home, I don't have to pay mortgage insurance. Not the case with FHA loan. You could put 50% down on an FHA loan. You're still going to have mortgage insurance. They come on all FHA loans. So that's just something you're going to have to deal with. They also have an upfront mortgage insurance premium. That's 1.75% of the loan amount, meaning that if you go and get an FHA loan, 1.75% of the loan amount is what you have to pay in an upfront mortgage insurance premium. Now that amount can be financed into the loan, but it can also be paid up front as well. Now, most people just finance it into the loan, but what does that mean? It means that your loan amount is now a little bit higher because now you're going to be paying that with interest. So that's something that you want to look out for in addition to that monthly mortgage insurance payment that you're going to have to make with an FHA loan as well. So that's mainly with the drawbacks. That's the biggest one, is just the mortgage insurance premium, the upfront mortgage insurance premium, and the monthly mortgage insurance that you're going to have to pay. In terms of how much the mortgage insurance is with an FHA loan, it tends to be very competitive, if not lower than what you will find with conventional loans in most cases. There are some cases in which conventional can be better, and I'll talk a little bit about that. But overall, those are the pros and the cons of your FHA loan. So let's slide over into conventional. With conventional, you've got some pluses. You've got no upfront mortgage insurance premium. You do have mortgage insurance if you put lower than 20%, or if you put less than 20% down on that home, but there's no upfront mortgage insurance premium with a conventional loan. That's one plus. Another plus is that mortgage insurance with a conventional loan will fall off automatically once you get to a 78% loan to value ratio, meaning that once what you owe on that home is 78% or less than the value of that home, that mortgage insurance will automatically fall off. Now, once your home gets to 80% of that loan to value ratio, and I might be talking a little bit of a foreign language here, so don't worry about it too much if this is going over your head. I'm gonna jump straight back into some very easier things to digest. But for those of you who understand the loan to value ratios, once your monthly mortgage payment, or rather once the loan balance, the principal balance of what you owe, is 80% of the value of the home, then you can request to have that mortgage insurance come off as well. So having that mortgage insurance being able to fall off a lot sooner with a conventional loan is something that can save you potentially $100, $200 a month, which could be very beneficial for you, because with an FHA loan, it's on there for the life of the loan unless you put at least a 10% down payment down on that home. And if you do put a 10% or higher down payment, you still have mortgage insurance, but you have to pay it for 11 years. So in either case, you're paying it for over a decade. And if you put down less than 10%, which most people do when they purchase a home, then you're going to be paying it for the life of that loan. So having that ability to have the mortgage insurance fall off, which is something that happens with a conventional loan, is beneficial for you. So that's another plus as well. You've got some of the drawbacks with conventional loans. We'll get into a little bit of the drawbacks. One of them is that you do have to have a higher credit score to get qualified. With an FHA, you can get 3.5% down payment with as low as a 580 credit score. But conventional, you're going to need at least a 620 in order to qualify for a conventional loan. But even then, I tend to recommend for most of the clients that I work with who want to go conventional that they need to have at least a 700 plus credit score. And the reason is because of mortgage insurance. Even though the mortgage insurance eventually falls off with a conventional loan, one of the things to keep in mind is that it is much higher cost. The monthly mortgage insurance that you pay is higher in most cases than what it is for an FHA loan. I've seen some cases in which people are paying $150, $160 a month more in mortgage insurance for a conventional loan than what they would have paid if they had just taken an FHA loan. So there are many cases in which I recommend people go FHA just because of the mortgage insurance alone. And this mortgage insurance for a conventional loan is heavily weighted on how much your credit score is, or what your credit score is rather. The higher your credit score is, if you can get a 720, a 750, a 780, a 800 credit score, then you could have a lower mortgage insurance payment every month with conventional loan than what you would have with an FHA loan. Because with FHA, your mortgage insurance is the same percentage for every loan. It's going to be the same percentage whether you buy an $800,000 house or $200,000 house. Is going to be the same. But with a conventional, your mortgage insurance changes drastically based off of two main things. First being your credit score, and second being how much you're putting down on that home, what your down payment is. And so if you have a really high credit score, then that's a situation in which you're really going to want to consider possibly going conventional, because you may have a lower mortgage insurance payment. You're not going to have any upfront mortgage insurance premium, and that mortgage insurance is eventually going to fall off of that loan as well. So another thing to state that I'll just throw in there as well, I didn't plan on saying this part, but I'll say it since it's on my mind right now. When it comes to getting a appraisal done on a home, appraisals for conventional, historically, I will say a lot of people have tended to lean more toward the conventional, because historically appraisals for conventional loans have been seen as being more lenient than appraisals for FHA homes, which have been a little bit more stringent. So I'll just leave that there and say that a lot of people have also preferred conventional just because the appraisals have tended to be a little bit more favorable for the sellers in particular. I can't really say that so much for the buyers, because you know what, maybe a more strict appraisal works in your favor, because if the appraiser's asking for repairs to be made and things like that, that's some work that you can get done on the house courtesy of the seller paying for that without it having to come out of your pocket. So I'll say it's been more lenient or more forgiving for the sellers, but maybe not so much for the buyers and with a conventional. But that's neither here or there, because you know what, you're not going to find that in every case or every situation. Situations are going to change, they're going to be different, and you're just going to have to move, pivot, adjust, and keep things moving forward. But getting back to the pros and cons of the conventional loan, as you can see, a lot of those cons fall around the mortgage insurance, in addition to that one pro that the mortgage insurance eventually does fall off. And if your credit score is high enough, you could also get a mortgage insurance payment that is lower than what you're going to find on an FHA loan. But moving from the conventional, because you kind of got an idea, and I'll leave you with this really quick before I move on to the USDA and the VA. A situation in which you will want to consider a conventional loan over an FHA loan is first, if you have a really high credit score, and by really high, I mean, let's go over 700, ideally over 720. But if you're over 700, you want to start looking and comparing mortgage. You want to start looking and comparing mortgage insurance of an FHA versus a conventional, comparing the monthly payment of an FHA versus a conventional. So that's the first thing, is that you really, when your credit score is above a 700, especially if it's well above a 700, maybe you're in the 750s, 770s, that's when you want to start looking at that conventional loan, because one, it might absolutely save you more money over the long term getting that conventional instead of going FHA. So that's the first thing. But the second thing is that you want to look at rather is your interest rate that you're going to pay. So this is one thing I didn't mention in the FHA, but I'm going to mention it here since we're doing a comparison. Historically, typically, what most people find is that interest rates for FHA loans tend to be better than interest rates for conventional loans. Typically, that's what you find. And so FHA is a government loan. Conventional is not a government loan, it's a private loan. And so typically you find lower interest rates for FHA than what you would normally see for conventional loans. That being said, you want to do a comparison and see how much you're going to be paying, because again, when it comes to interest rates, your credit score is going to have a huge impact on the interest rate that you get and how much you pay for that interest rate. And so you want to always be working on improving your credit, making sure you pay all your bills on time, keeping your credit card balances low. Doing those two things alone will help improve your credit drastically. Just continue doing those two things over a long period of time. Your credit scores will go up if you pay everything on time and you keep your credit card balances low. But getting back to the interest rates for FHA versus conventional, they may be a little bit higher for conventional. That might be something you want to consider, because if you do have a higher interest rate for a conventional loan, that is going to affect how much home you qualify for. And if you're on the cusp of qualifying and not qualifying for that home that you really need, that's going to work well for you and your family, that's one situation in which you might want to switch over to an FHA, which the debt to income ratios are a little bit more forgiving with an FHA loan, meaning that the home that you'll be able to purchase, let's say if you're able to purchase a $500,000 home for a conventional, but that puts you at the very limit of what you can get approved for under a conventional loan. And then, if your homeowner's insurance comes in high, that's going to push you over the limit. Well, when you go to a FHA loan then FHA tends to have better debt to income ratio limits. So an FHA loan will allow you to go up to a higher debt to income ratio than what you can get with a conventional loan. And because of that, you could get that home that you really want under an FHA that you might not be able to get under a conventional loan. So you want to do those comparisons, but mortgage insurance is going to play a big part of that as well. So just make sure that, or not mortgage insurance, rather, mortgage insurance will play a big part in that, but interest rates will also play a big part in that as well. So you want to make sure that you are checking in on the comparison of those interest rates. But you don't even need to be having this conversation unless you've got a 700 plus credit score. If your credit score is below a 700, FHA all day. That's what you need to remember. If your credit score is below a 700, FHA all day. That's where you need to be looking to get approved for a mortgage. But if you're above a 700, now you need to start doing those comparisons between, is it better for you to go conventional or FHA? And one last thing I will say before I move on, I said the last thing was the last thing, but I had another thing that popped in my head that I think is going to be really good for you. So I'm going to mention this thing additionally, because a lot of people are needing down payment assistance in order to purchase a home. And so when you need that down payment assistance, most down payment assistance programs fall under FHA financing, not conventional financing. And part of the reason is because of mortgage insurance. FHA is consistent. It's a government loan. Conventional is all over the place depending on your credit score. So if you're looking for down payment assistance or you need down payment assistance, FHA. So if you need down payment assistance, aka DPA, go FHA. DPA, go FHA. If you're under a 700 credit score, FHA. So two things you remember that will help you decide, do I need to compare with conventional FHA or do I just need to go FHA? If you are under a 700 credit score, just go ahead and look toward FHA. And if you need down payment assistance, FHA is going to be the direction that you're going to want to lean in, because that's where most of those down payment assistance programs will be. You do have a couple out there for conventional, but the majority of them will be for FHA. Moving on to USDA, and then we're going to wrap it up with my favorite, VA, and you're going to find out why it's my favorite in just a moment. But getting to the USDA, obviously USDA is what I like to call a hidden gem. I say obviously as if most people know what USDA loans are. Most people don't know about USDA loans because it's not a highly utilized loan program, even though it has huge benefits. One of them being that it does not have a down payment requirement. There's no down payment required for a USDA loan. So you can go and get 100% financing on a home that's in a rural area if you are a low to middle income borrower, and get great, it's not mortgage insurance, what they call it a loan guarantee fee. But that yearly guarantee fee that you have to pay for the for mortgage insurance, if you will, for a USDA loan, it's very competitive with what you find on an FHA loan. So again, you're not paying these super high rates that you might be paying with a conventional loan. So it's very competitive there. USDA also has very competitive interest rates. So I'm telling you all the pros about it right now. So they've got very competitive interest rate pricing for USDA loans as well. So you've got competitive interest rates, competitive mortgage insurance, 100% financing. That's huge. You don't have to have a down payment. So a lot of things right there to like about the USDA loan. But here are a couple things that might be something that you want to pay attention to. One of the things is that USDA is meant for low to middle income borrowers, meaning that if you make above a certain amount, you are automatically disqualified from that USDA program. Low to middle income, they have income restrictions. Another thing, USDA counts the income of every individual that will be in the house. They don't just count the income of the person that's going to be on the loan. So if I'm going to be purchasing a home under a USDA loan, they're not only going to look at my income. If let's say I'm going to be the only person on the loan, they're not just going to look at my income. They're going to look at my wife's income. If I have a child who's 18 years old or 20 years old that lives in the house, they're going to be looking at that individual's income, and they're combining all of our income together to see if we're over that limit. So if I were just purchasing the house by myself, I might be better off if I'm a low to middle income borrower by myself. But if you add me and my wife, and that might easily push us above the limit, and that could disqualify you from being able to purchase a home under a USDA loan. So that's something you want to keep in mind, is that if it's just you, make sure you're under that limit and you'll be good. But if you've got other individuals in the home, other adults in the home, even if they're not going to be on the loan, their income is still going to be counted as well with that USDA loan. So that's another drawback with that, if you will. But another one with the USDA loan is that it is area specific. So you can't purchase a home under a USDA loan everywhere. It has to be in an area that qualifies for USDA financing. And so with that, there is a website, and I'll actually drop the link in the description below, where you can search if the home that you're looking to purchase is in a USDA qualified area. Now, if you're in a city, don't worry about searching, because downtown areas of major cities are not going to be qualifiable for USDA financing. However, it's financing that's more meant for rural areas that are in, housing that is in areas that tend to be more rural. But I'll also throw in suburban, or the outer limits of the suburban, if you will, because there are some areas that qualify for USDA financing that are a 20-minute drive from the city, a 30-minute drive from the city. So you'd be surprised about how far or how close you can be to the city and still qualify for USDA financing. So if you are one of those people that you don't want to live downtown, you want to live in the outskirts, maybe in the outer suburbs, you should check and see if the houses that you're looking at actually qualify for USDA financing. Because if they do, you could end up getting a home with no down payment required, meaning you only have to pay closing costs, have competitive interest rates, low mortgage insurance, or that low guarantee fee that you have to pay for USDA loans. And it can end up working out a lot better for you as a home buyer as well. So that's an option for you. And USDA can finance new constructions. They can finance just about everything. There's a lot of different things that you can finance under a USDA loan. So that could be an option for you depending upon where you're wanting to purchase and depending upon what your income is. So you want to talk to a loan officer about that. Now, with credit scores, when it comes to USDA does not list a minimum credit score limit. However, they prefer for your credit score to be above a 640. That's higher than what you found with the conventional loan. So that's another drawback, if you will, or another thing that you need to be aware of is that USDA loans, we started from the low end. It's like we're working our way up now. With FHA, you had to have a minimum 580 to get that 3.5% down. With conventional, you need to have at least a 620, and then you could get a conventional if you're a first-time home buyer with 3% down. But if you're not a first-time home buyer, you'll need at least 5% down. But now we're at USDA, and USDA wants to see a credit score that typically is above a 640. You can get qualified with below a 640, but they prefer to see, and it's easier to get qualified if you have a credit score that's above a 640. And they have zero down payment requirement for that USDA. So that's something you want to remember as well. Moving on from USDA into my favorite loan product. As a veteran, I'm going to give it all up for the VA Home Loan Guarantee Program, which is totally there to support our veterans who are looking to purchase a home, get their home ownership journey started, start building that equity through home ownership, wealth through home ownership, all the great things that come with that VA home loan guarantee. So the VA loan is, in my opinion, by far the best loan program out there. If you are a veteran, if you are a surviving spouse of a veteran, you should be looking into, or if you are active duty military, you should be looking into utilizing the VA home loan for your financing option to purchase a home. Two things right off the bat that are huge with the VA loan, huge positives. One is that with the VA home loan, there is no down payment requirement. Just like the USDA has no down payment, the VA loan has no down payment requirement, 100% financing. Second thing, unlike all of the other programs that we mentioned previously, the VA home loan does not have mortgage insurance. That's going to help you out hugely on your debt to income ratio because you're not going to have to pay any mortgage insurance. So that might save you an extra 150, 200, 250, 300, depending on how expensive the home is that you're purchasing and where your credit score falls. There's no mortgage insurance, regardless of what your credit score is. The VA home loan does not have mortgage insurance and it does not have a down payment requirement. So those are two big things right there that can save you a lot on the upfront cost and your monthly payment as well. But it continues to get better because the VA also does not list a minimum credit score requirement. So you can get a VA loan with a 580 credit score, 570 credit score, 600 credit score. I will say though, you should strive to have higher credit because the higher your credit is, it's always going to play to your benefit because interest rates are still based on credit, meaning that you have great credit, you could get a lower interest rate or have lower pricing, meaning that you're going to pay less for the same interest rate than what you would pay if you had lower credit. So you should always strive for higher credit. However, VA does not list a minimum credit score requirement. I will caveat that by saying, even though the VA does not have a minimum credit score requirement, most loan office or most lenders do. And so because of that, the VA might not have a minimum credit score requirement, but you go to get approved through fill in the blank lending and they have a minimum credit score requirement of a 620 for VA loans or 600 or 580 or 560 or whatever it is. They have a minimum credit score requirement. And so even whatever the VA's limit or lack of a limit is, mortgage lenders can have what are called overlays, meaning that they have their own restrictions and requirements that they can put on top of whatever FHA, VA, USDA conventional programs that are out there. So just keep that in mind as well. But that is a plus. Another plus is that the VA does not have debt to income ratio limits. So whereas you've got limits with the FHA, you've got limits with the conventional, you get to a VA loan, there have been some people with 65%, 70% debt to income ratio limits that have gotten approved for a VA loan. And that could be huge, especially if you're working a job where maybe the income's not as much, and housing prices, we know what direction they're all headed in, but you could still be able to qualify to purchase a home and start building on some financial stability and everything. Now, it is high if you've got debt to income ratio limits that are that high. However, it doesn't have to stop you from being a homeowner, because the VA does not have a limit on that. You've had some people with some crazy high limits on debt to income ratios. I'll caveat that and say, be financially responsible. Just because you can get approved for something doesn't mean that you should purchase at that purchase price. Just because you can get approved for a $450,000 home with a 75% debt to income ratio does not mean that you need to go and purchase a $450,000 home at a 75% debt to income ratio. Maybe you need to back that off to where most of your income is not going toward paying debt. Maybe you need to back that off to where now we're looking at maybe a 60% or 50%. Something much lower, where a bigger portion of your income can help go towards savings, because you should always be saving money out of every check that you get. Some of it can go towards an emergency fund if you haven't built up an emergency fund for those emergencies that will come up in life, because they will come up when you don't have an emergency fund. When you have an emergency fund, odds are you don't need to tap into it, but if you do, then you've got the money there. But you should also be saving for retirement as well, because it's going to be coming up at some point, whether you're decades away or whether you're just a few years away. You should be putting money away for retirement as well. So you don't necessarily want to max out everything that you can get from that debt to income ratio out of the VA home loan, particularly if it's a really high limit, because you want to make sure that you are being responsible fiscally, financially, with the funds that are coming in. But that being said, the VA is huge, and you can use the VA for pretty much everything out there. You can purchase condos, townhomes, single family homes, multifamily homes. Even you could purchase a quadruplex with a VA loan and use the rent from the other 3 units that you're not living in, because you can only purchase a primary residence with a VA loan. I'll mention that as well. Same thing with the FHA loan, same thing with the USDA loan. Conventional is the only one that you can purchase a investment property with out of these 4 that we're talking about in this episode. But you can purchase a quadruplex with a VA loan. You can live in 1 unit and you can rent out the other 3 units. And you can use the rent that you're receiving from the other 3 units to qualify for the mortgage for the entire quadruplex. So it's not that you have to make enough money to qualify for the whole quadruplex by yourself. You can use the rent money that you're going to be getting from those other 3 units to help qualify for the mortgage for that quadruplex. And that's huge in helping you be able to not only get started with home ownership, but started with having an investment property as well as a primary residence, all built into one. And then when you move out of that 1 unit later on, let's say you move out of that quadruplex that you're living in, you keep the quadruplex, you rent the 1 unit that you were living in it, and now you have 4 people paying you rent to cover the mortgage and hopefully kick off a little bit of extra for that quadruplex that you own while you go on and wash, rinse, and repeat with the next home. So you can actually get some investment stuff getting started with this VA loan as well, using that as a springboard or as a launching pad to get things going with building this real estate portfolio. So a lot of great things that you can come across with the VA loan. When it comes to downsides with the VA loan, I'm gonna be honest, I have a hard time coming up with downsides for the VA loan, because you've got super competitive interest rate pricing. Like I said, no down payment, no mortgage insurance, no debt to income ratio limits, no purchase price limits. If you have 100% all your eligibility. So if you have not used any of your VA eligibility, then or if you have full eligibility that's been restored, full entitlement that's been restored, then if you haven't used any entitlement, any eligibility, sorry, I lost my train of thought for a minute, then there is no purchase price limit. So as long as you've got all your entitlement, then you want to go purchase a $1.5 million property. If the lender will finance $1.5 million, you can purchase it under the VA loan with 0 down, no money down, no mortgage insurance. And so that is That's a huge thing right there, because that could take you above the county loan limit for whatever county you might be living in. But you can still purchase it all with 100% financing under the VA loan, as long as you've got a lender that will loan you 1.5 million to get that home. So there's so many pros to it. Another pro that I'll mention when it comes to the appraisals, because I mentioned appraisals briefly. When it comes to the appraisal with the VA loan offers more options than any of the other loan programs to be able to get that value looked at again. So let's say if you are going to purchase a home that you really want, but that purchase price for the home is, or the appraised value rather, is coming in lower than what the contract price is for the home. Well, you can do a reconsideration of value with that. So you can, there's two processes. You got a tidewater that you can do, but you can also do a reconsideration of value as well. And so you've got a couple of different ways that you can address a low appraisal with a VA loan to try and get that value kicked up to where you need it so that you can purchase that home as well. So a lot of great things wrapped into this VA loan. Again, it's the one that I'm not really going to mention any downsides for, because I have a hard time finding downsides for the VA loan. I mean, if you want to mention a downside, just so we can keep it even, I guess you could say, keep it fair, the VA loan does count what's called residual income. And residual income is something that is only calculated on the VA loan. You don't have it on any of the other three that we mentioned. So what is residual income? Well, residual income is the amount of money that the VA has determined you need to have left over after you've paid all your debts. And that amount is dependent upon where you're living geographically in the United States and what your family size is, how many kids you have. It's also dependent upon the square footage of the house, or that factors into it. But that determines what your, those other things I mentioned determine how much you need to have residual. So let's just say that the VA determines that your residual income is, I'll just throw out a number and say $1,600. That means that after all of your expenses have been paid, after you've paid all your debts that are listed on your credit report, and after you paid this proposed mortgage payment for the house that you want to buy, you need to have $1,600 left over. But the other thing, in addition to all your debts and the proposed mortgage payment, the VA also calculates how much your utilities and expenses are going to be, and they base that on the square footage of the home. VA also counts childcare. And we all know how expensive childcare can be. But if you've got kids who are currently in daycare, you've got childcare expenses for them. Maybe you have a nanny. That's going to be something that might put a dent in your ability to qualify under the VA loan, because it might end up not giving you enough residual income, meaning enough income remaining after you've paid child care, after you've calculated, or after your loan officer has calculated all of the utilities by doing the calculations with the square footage of the home that you're looking to buy, after the mortgage payment's been calculated, after all your debts have been calculated. You still need to have money left over. And that's something that can be seen as a drawback. The reason I don't really count it as a drawback is because with that residual income, that's to your benefit. Having money left over after you pay for all of your expenses is to your benefit. So that's one reason I don't really consider it a drawback. And that's because if you had all these expenses that you will have, and at the end of it, you don't have any money, you're not saving for retirement, you're not saving for emergencies, you're not able to take care of, things that just pop up here and there. So I think it's actually to your benefit to have that in there. And it actually has historically, I believe, helped the VA have a much lower foreclosure rate, delinquency default rate than what you will see with a lot of other loan programs, some of the other ones that we mentioned as well. So I believe that is to your benefit, but it is something that I will say you do need to be aware of, because it can be an inhibitor to you being able to qualify for a VA loan, depending upon what those other expenses are, which may not be calculated, or which won't be calculated by other loan programs. For example, no other loan program calculates childcare except the VA loan. So that's just something you want to keep in mind. But those are the 4 loan programs. If you are a veteran, don't even look at all the other loan programs. Go to the VA first and see what you can get qualified for under the VA loan, because that is going to be the best option for you. I truly wholeheartedly believe the VA loan is going to be the best option for you, unless you want to purchase an investment property, in which case you're going to want to look into a DSCR loan. You're not even going to want to look into one of these options. There are so many other loan programs out there. I'm not going to get into them in this episode, but you're going to want to look into a DSCR loan or one of the other loan programs. But if you are purchasing in a rural area or outer suburban area, maybe a middle suburban area, check and see if you qualify for a USDA loan. And if your income qualifies and your credit score meets the limits, maybe it's above that 640, maybe you're in the 700s, you want to consider that USDA. If you have a really high credit score, look at that conventional loan. We're at the 700 plus, the 720s, the 750s, the 770s, the 800 club. You want to look into that conventional loan, because that's going to be something that's really going to help you there in terms of mortgage insurance and possibly getting that mortgage insurance to fall off as well. And like we started, we will also end when it comes to FHA loans, which tends to be the king for first-time home buyers. If you're looking for down payment assistance, FHA's all day is going to have most of your down payment assistance programs with an FHA loan. If your credit score is below a 700, FHA all the way. So that is what I have for you. A little bit longer this episode, but I really wanted to break down those 4 different loan options for you and give you an overview of the pros and the cons of each, to help guide you to the best loan program to help you get qualified to purchase that home. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you next week.